Hi, welcome to Talk Your Chart. If you love charts, trends, and a little bit of economic trivia, you're in the right place. My name is Marco Segrera, here with my wonderful friend and colleague Brett Horowitz. Here we go. Brett, you've brought the house of charts with us, so let's.
Chart number one. How does a company like OpenAI, which is on pace to make $20 billion this year in revenue, lose $9 billion after accounting for expenses? The problem is, right, technology is all in the news now. OpenAI is what's boosting the market forward. Everyone's all in on what's happening technology wise. Here's a few stats for you that you may not be aware of. OpenAI, the company that released ChatGPT, in the last 9 months has committed to spend $60 billion a year for computing from Oracle, shell out $18 billion on a data center venture, build a new mass market AI hardwire device, and purchase $10 billion of chips. If you think that's not a lot, Alphabet, Microsoft, Amazon, and Meta are set to spend 400 billion this year on capex, most of which is for their AI, more than what the EU spent on defense all of last year. The problem is none of these companies have the money to be able to pay for these things. Um, since ChatGPT opened or was released 3 years ago, OpenAI has 700 million users. Terrific. However, only 3% of users actually pay for AI. And a McKinsey consulting study just said basically recently that 8 in 10 companies report no significant bottom line impact of using AI and do not, as I said, do not spend for AI. So the good is that maybe at some point we start to and then we catch up. The bad is that it turns into a huge bubble like we had in 2000, the dot-com bubble, where a lot of companies go bankrupt, a few make it, and it takes decades after that until we finally catch up to the power and potential that AI has.
Okay, fine. I'll still man bull. If you don't know what dark fiber is, Google it. Dark fiber is what got laid during the tech bubble. Basically saying we think demand is going to be this in the future, so we're going to lay fiber that is not going to be used right now, but it will be. Eventually that came to fruition, but it took 10, 15, 20 years. That's not the current case. Every GPU that goes online, Stargate, which is going to be what, like 50 gigawatts or something like that, it might even be more than that, is going to be 100% at capacity as soon as it's built. So everything that's going into the plumbing of AI is not going to be dark. It's immediately going to come online. I think the total addressable market, off the top of my head, from what I've read, is between $2 and $10 trillion. So you'd be willing to spend a multiple of the total addressable market to be able to recoup that over time.
But every company is doing that now. I don't think every company is going to make it, right? You've got a lot of competition for the same eyeballs, for the same dollars.
Yeah, but I think those eyeballs are constantly changing and adapting, and they're not all spending 70 trillion, right? They're in the billions right now to get to trillions of dollars. So if you look at the total addressable market and you believe what the total addressable market is, technically it's defended. I think the question ends up becoming what's the ROI of the next use case, meaning if it's just me or my son going on some LLM and having fun with it, that's not all that advantageous. But if it's a company replacing workers, which we're already seeing happen if you look at the job numbers, right? Not in our world, right? Sorry, we're just not big enough. We're not good enough at it. But if you look at the S&P 500, it's happening. So my guess over the next 20 years, over the next 10 years, go even less than 20. The 10's within 20, but I'll even go within the next 10 years. What you saw from 2000 to 2025, which is the revenue divided by total employees, went up, up, up. That's going to go bananas. And you're going to get a crazy upward pressure on revenue divided by total employees.
It could be. That also came after a 50% decline in the dot-com bubble. So
I think you have to expect there's going to be winners and losers here. We'll see who kind of has the fake. There's going to be grifts. I don't think like as an example, I don't think OpenAI and Nvidia getting in cahoots here is actually all that. It looks suspicious, but it's not, because all Nvidia is doing for OpenAI is kind of fronting them some cash to be able to put plumbing in place that's gonna have demand for it. It's not fake demand.
Well, we'll have to see, right? I mean, right now, you and I spending $10 a month or whatever it is, or nothing to get our Chat GPT is not going to move the needle. You need companies to go all in on this and spend lots of money to say we're going to change our entire way we do business. Um, and remains to be seen if that's going to be the case. But right now, it's amazing how much they're spending and how much they're still losing. And
Yeah,
so
I agree.
Amazon did it, right? We know that they lost a lot of money before they made money. Maybe this is the same thing. Who knows?
Yeah, and look, if we go through it, Amazon got chopped by 70%. They just had enough revenue to stay around. So if we go through it, there'll be winners, there'll be losers. We'll see what happens. Um, don't
Okay.
put all your money in one company. Yeah.
No, definitely not. So let's shift to an article that Fidelity just came out recently with. It was called Why the Bullish Market May Have Years to Run. And there's a number of different charts here that we're going to go through to show why they think this has got a lot of legroom still left in this bull market. The first chart here shows sort of past generational peaks in bull markets and how long they lasted. And they've said on average it's 19 years. And so it should go on for another 7 or 8 years. Who knows if that's the case? But that's the first chart where they say this thing's got a lot of legs left. The second chart is using a regression line to show that the S&P over time has gone up. That's what we know. It does have dips, but over time it does go up. And while they look at that and say, yes, it's slightly over that regression line right now, it's not even noticeable unless you really zoom in.
Yeah.
So it's not as if it's outrageously expensive like it has been in the past. The third chart shows that it is overbought in terms of the percent over under trend line growth, slightly overbought. But they look at it and say if it's over 70%, that's where they start to get nervous. The guys that wrote the article said we're not there, so it's a little bit on the expensive side, but not too bad. And the fourth chart basically shows if we compare where this thing has gone from the dot-com era to where it is now during this sort of new AI era. Dot-com era was so much more explosive in how long it lasted and how much growth it had, that if this AI comes anywhere close to that, we still have a huge leg up going forward, that the bull market is nowhere close to over, even if it may have time from time go down occasionally.
Yeah, I think I didn't know this. It was remember Irrational Exuberance? That was December 5th of 1996. When the
I'm
crash
Greenspan.
when the crash happened, yeah, Greenspan, the market bottomed at a higher level than when he said that.
It was up 107% in the following 4 years.
Yeah, so he called it real early, right? So good luck trying to time these things. You can be right and still be wrong, and then if you happen to be right, you got to get right on the way out and got to get right on the way back in. My favorite chart here that you shared is the past bull markets and the one that's calling out generational peaks and new all-time highs. The part for me as a person who plans to be invested for a long time are those long periods of flat performance. Oh, that is stressful to look at. Unavoidable in nature. You have to prepare for them before they come to pass, and that's owning other assets besides the S&P 500. Right? That's kind of the only way that you can combat something like that.
Well, that to be fair to them, they make two points that are very important. They say number one, even though we think this bull market can keep going for a lot longer, it doesn't mean that pullbacks are not going to happen. They're inevitable, right? We know the 14% declines every year that the S&P typically has,
Yeah.
so it's going to happen. Number two, they said it's not meant to say the bull market will last that long, because they say if the secular bull were to end earlier, it would just be far shorter than the previous two. So they're not saying that this is going to be a target and that it's got to last 19 years. They're saying if it doesn't, it's less than the last two. But 19 was sort of how long those last two happened.
Yeah, since 1949, your average bull market is 1,945 days. Divide that by 365. I don't know what that is, but it's a number that's longer than how long this current bull market is, which is 3 years. It just turned three, actually. So we're out of the terrible twos, which is great. on to three, and we shall see. The previous bull that ran from 2020 to 2022 lasted 651 days. Right now we're at 1,098 days, so 900 more days to go. Right? We'll see what happens. What else have you read into the Stargate project at all? That big AI build out in Texas. It's incredible what they're doing. If you haven't seen that video, I highly recommend. One of the folks that does basically like capital market raising and equity investing for data center stuff, they got a drone and just flew it over the whole area. And oh my gosh, it's like a big city. It's like Manhattan times two or something like that. It's pretty impressive.
Gonna need a lot of electricity. Gonna need a lot of people, at least
Yeah,
initially.
it's electricity. That's going to be the biggest piece. We won't talk about what China's been able to do that we haven't been able to do there because we already talked about that.
Yeah,
My
wind power is not gonna get it done alone.
All right, last chart here, Brett Horowitz. With those were good charts from Fidelity. I like them. Um, let's talk a little bit about the U.S. versus outside the U.S. I forget what our predictions were. I just seen them, but we always kind of flip flop between what's going to do better, the U.S. equity markets or the outside of the U.S. equity markets. And in 25, it's been an outside the U.S. winner, and it's been further magnified by just a little bit of a down period for the U.S. dollar. And this chart here from our friends at Yardeni is just showing us the value of developed countries in the MSCI within the U.S. Divided by all countries out in the world. So it's basically just kind of comparing the U.S. performance compared to everybody else. And you can see from 2010, there's just been this big divergence of the U.S. has been the place to be. That's going to be a function of technology was a place to be, and we are the home to the most successful revenue producing technology companies. But we've had this little bit of an uptick in the international markets, which is unfortunately only reflected in that little uptick that you see in the blue line at the bottom, right before it's kind of dipping back down again. So we shall see what that turns into.
Am I reading this correctly? This is the percent of the MSCI represented by the US, represented by Europe, represented by Japan?
Yes, exactly. So
So the MSCI is a world index, and this is
yes,
saying the US is becoming a larger and larger percentage of that world index, presumably because it's performed so well over the last few years.
exactly.
So now owning a world index means you're owning more of the US and owning less of the other stuff.
Yeah, exactly. And even though we've had a little bit of a flip in this year, both ratios, meaning the ratio that is adjusted for U.S. currency versus not, are still both in an uptrend. So if we get a flip of this, it's still not present. And I wanted to throw a few kind of stats at this to kind of just speak to why this outperformance has been happening. And it starts with forward earnings. So the forward earnings of the U.S. MSCI has increased almost twice as fast as the forward earnings of the rest of the world since 2010. The forward profit margin of the US MSCI is sitting at 14%, which is well above the 10% in the rest of the world. And this one was pretty shocking. Before 2010, the forward price earnings ratio of the US MSCI tended to be 10% higher than the rest of the world. Since then, it's risen to about 70% at the start of this year. Now it's sitting at about 55%. That was a shocking statistic.
No, we've seen more and more clients who've been asking about why would I want to hold foreign stocks. The U.S. is the place to be. It certainly has been for the last 10, 15 years. The question is, does it go back to the beginning of the chart, where it's a much more sort of even 50, 55% to 35% Europe, or does it keep going higher and higher? There's obviously a lot of tailwinds in the U.S. right now, but for 100 years, it's been relatively similar, U.S. versus foreign. The last 15 years has not been that case. So I don't know where it's going, but it's certainly interesting. We do have a home country bias in our portfolios, right? Two-thirds U.S., one-third foreign. So that's worked out for us. I know some people would want it to be all 100% U.S., but that's like selling only rain umbrellas and not sunscreen at the beach. You want to sell both just in case it's a rainy day or a sunny day.
Yeah, unfortunately, I agree with you. I think you can have an okay experience if you just invested in the U.S.
Yeah.
And you can defend it by saying 50% or just north of 50% of the revenues from the S&P 500 are generated outside
Right.
of the US. But behaviorally, you're going to get these moments in time that can last for a long time when you're just out of favor. And it's really hard to stay invested and stay consistent and persistent in those moments. And the international diversification just really supports you in those moments in time. So innovation has been rewarded, thankfully. That innovation has been in the US, also thankfully, as a person who lives in the US. So we shall see what outside the US can come up with. Because right now, if technology is the new industrial energy, right? If you look at the composition of these large indexes 20 years ago, it wasn't tech at the top, now it is. If that's going to stay that way, then Huawei better figure something out.
Well, technology is certainly huge, but also price to earnings is high on the U.S. and you have currency risk in there as well. So why is foreign up this year? You can't say it's because all of a sudden they're innovating this year, right? There's a lot of other factors in play. People taking their money out of the U.S., putting in foreign. You've got the depreciation of the dollar. So all these things are in there, and that's why foreign is up twice as much as the U.S. So you can't just use the long-term view and say, that's going to affect every single year.
Yeah, you got South Korea up 56%, Spain's 38, China's 36. No one's talking about that. Hong Kong 25, Italy 23, Taiwan 23. So yeah, who knows where this goes?
Maybe we add to our predictions next year, country of the year.
Oh God, there's too many things we predict already. All right, bro, that's it. Oh, by the way, this is also one of the most hated bull markets ever so far, which leads me to believe we got room to run, my friend. We
Good.
got room to run.
I hope people don't believe it's going to continue. Doubt us. Doubt the market.
I hope so. That's so
Yeah.
very, very helpful. Right now on the streets and in conference rooms, I'm getting more questions about when this thing's turning over, and that's good for the bull market. That's good. Climb the wall of worries.
Too much optimism is never a good thing. So agree with you
I
there.
know. Oh man.
Have a good one.